So we were expecting pretty good earnings after what we saw from the other banks yesterday. What were the key takeaways?
Well, a strong quarter, though, when you compare to the first quarter, it is slightly slower. We have net income coming in at about 1.7 billion Sing dollars. That's an increase of 37%. Remember that this is on the back of a 70% uptake for the first quarter. So quite a slowdown from the first quarter, but that was really an outperformance in Q1. In terms of dividend, also higher than expected. We have dividend payout at 33 cents per share versus 18%. What's interesting is the loan provisions. It is lower on the back of a 99% decrease back in Q1, but not the same as the likes of Standard Chartered's global peers, where we saw a write-backs. That suggests that Singapore banks are pretty much cautious. It remains in wait-and-see mode to see how the recovery pans out. So that's a key takeaway when it comes to Singapore banks, and DBS suggesting just that.
DBS has been growing in large emerging markets. What's the outlook there?
Well, it's looking pretty good. Remember that DBS earns 70% of its income from outside of Singapore, the likes of India, the likes of China, and it continues to grow. What we're watching out for is whether or not it takes an additional stake in that bank in Shenzhen, where it bought a 13% stake for $1 billion. Also, we're keeping a watch on city assets in India. It has said it is interested in buying that because of its wealth management business, a credit card business. So if it were to buy that, it would come at a cost of about $2 billion. And analysts say it can afford to do that without, trying to raise additional funds. So keep a watch of those two.